Hi guys, welcome back to the channel. My name is Dave, and today we're talking option basics. This is part 3 in a series. It's my option playlist all about the basics. It's linked here and down below called Option Basics. So hoping to be a resource of choice if you're just trying to learn about basic options. Again, this is part 3, so part 1 and 2 are linked down below. And that's when we were writing options out, selling puts and selling calls. And now we're going to flip to the other side and start talking about buying calls and what all that entails, kind of working through the guts of buying and selling puts and calls. So if that is what you're looking for, please stick around. Whoop. So I want to start this video by reviewing the put that we sold and the call that we sold. Now, if you feel really comfortable with this information, you want to jump ahead to buying a call, that will be down below, and I'll have the chapters all set up so you can jump right to buying a call. But I think it's important to kind of take a look back and see what we've done so far by selling this put, selling this call, and the results as of today. So today is 10/15. So at the close on 10/14, I have some of the results of where these options stand at this time. So let's go back to that selling a put, that first one that we wrote with all those instructions. And again, we picked the ticker symbol KO, which is Coca-Cola, and we're going to stick with that throughout this course as kind of our example piece. So when we did this, it was at $56.02. Right, we sold to open one put contract, so we were down one contract. We sold a contract, right, and that was a put. We did this because we were bullish to neutral, and we wanted to collect that premium, right? And the strike price was 50, if you remember right. So now we're going to look and see where this is on 10/14. So if you remember right, we collected $35, not that much, but it was pretty far out of the way, right? It was at 56 and it had to drop all the way to a $50 strike price in order for it to be put to us. So we felt pretty good about two things. One, we got $35. Two, we liked the valuation of having Coke assigned to us at $50. So with those two things in our corner, we feel pretty good about this trade. So if I pull up the information now for 10/14, I'm going to see that the stock price is now at $54.98. And if I wanted to close out this contract, just like we talked about in part 2, I could do that now, and it would end up costing me $27 to close it. So I would buy to close, and the premium that it would cost me to close that would be $27. So now I would have made $8. If you remember from part 2, I think we lost $9. We were in the hole by about $9 at that time. So what has changed since then? Well, the stock price went up a little bit, and Pepsi came out with really good earnings news. And earnings are coming up for Coca-Cola as well. So on the back of good earnings news from Pepsi, it looks like this has helped out our option position a little bit. So at this time, if we wanted to close it, we would pay $27 and we would net out between $35 and $27. $8 would be our gain. So at this point, we're in positive territory. Now, it's not a lot of money, I realize that, but it is a start. Now with this option, we still have 3 weeks till our expiration on 11/4. So it's 10/14. We still have 3 weeks to try to grab the rest of that $27 in premium. So as I stated, at this point we've made a little bit, but I'm not going to change anything. I'm just going to leave this one open, still feeling pretty good that I'll be able to collect that $27 in premium. But I do know in the back of my mind that Pepsi had pretty good earnings. Coke, similar company, might also have the same situation, which should help the stock price, and that's coming up. So feeling pretty good about this position overall. And this is what it would look like if we wanted to close that put out on Fidelity. So here we are buying to close one put contract on November 4th. It's that $50 strike. And you can see there's the bid and ask. It's a pretty decent size spread between $24 and $31. But right around the middle, it would cost us $27. So that's what it would look like if we wanted to buy to close and get out of this contract. So in part 2, we talked all about writing or selling a covered call. And we said the order of operations here was really important, right, when you're just getting started with options, if you remember. And that was the requirement of having the 100 shares and then going to sell the call. So I'm going to say that right up front. Now we picked the same thing. We're doing with Coca-Cola. We did it when the stock price was at $54.51. And it was on 10/7 when we sold to open a contract to a buyer out there. And this in case it was a call. So first we did a put, now we did a call. And with a call option, we're allowing the other person to call away our shares. That's why it's so important that we have those shares in the first place. And we do this when we're kind of bearish on the stock. We just don't think it has much room to the upside. So why is because of the premium that we can collect. Just like anytime when we sell any kind of contract like this, they're going to pay us a premium. In this case, it was $65. And we did it also because we like the value at $57 strike price to get rid of Coca-Cola. We don't think it has much more upside, so we're willing to sell our shares at $57 a share. Now, our expiration date on this one is 11/4, the same as the previous one. So we have 3 weeks till expiration at this point. We collected $65. And our requirement, as we said, is to buy the shares first, then sell the call. So we have 100 shares that we have to make sure we buy first. That was the cost to buy the shares, and therefore that's our break even. So again, you can go watch this in part 2 if any of this is over your head and review it. Now, if we look at 10/14 as of the close, the stock price again was at $54.98. If we wanted to get out of that 3 weeks before expiration, we would just buy to close that contract, and it would cost us $73.65. So if we go to close this, now we receive $65, but it costs us more than that to close it, $73.65. So at this point, we would lose $8.65. So do we want to close this out now and lose $8.65 in the trade? I would not. Now let's go back and look at what we actually did here. So we bought 100 shares at $54.51. If the stock, if it comes out with great news through earnings and Coca-Cola takes off and goes past $57 a share, I will let this go, right? Because I'm going to receive that $65. I already received that. I received that when I sell it. But I'm also going to receive the difference between 57 and 54.51, right? So that's about $250. So again, I bought it for 54.51. I'm going to sell it for 57. So altogether, I've made over $300 on this trade. So am I going to close this and lose my $8.65? Certainly not. I'm okay with it as it sits right now. Let's wait for some more time to go by, and let's review it again next week. And this is what it would look like on Fidelity if we went to buy to close that contract. So we were buying to close one call contract with that expiration at a $57 strike price. And again, see the bid and the ask, and right in between there is right around $73.65 as a market order is where it should execute. It should be close to that number. So now it's time to flip the other side and become a buyer. So we got to change our mindset a little bit. Up to this point, we've been writing or selling puts or writing or selling covered calls, right? So when we're writing, we're there to collect that premium. When we're buying a call, we're making a directional bet that we think we know a stock's going to be going up and down. And when it's a call option, we believe it's going in a positive direction, shooting to the moon. That's got to be our belief when we buy a call. Because we're looking for, I guess, probably a great way to think about it is you're looking for volatility where volatility is not expected. Now, we're doing Coca-Cola across earnings, so everybody knows that there's going to be some volatility when earnings come out. They don't necessarily know if it's going to go up or down, but that's going to increase the premium that we have to pay for this option. So we got to have that belief that we know the direction. There's a little bit of Vegas-style gambling in this, doesn't it? That's kind of how it appears. Now, that doesn't mean you can't make money by buying puts and calls, but it is a little bit of a different mindset. So let's start working down through this and talk about some of the finer points. So again, Coca-Cola stock price is $54.98. And we look out there on 10/14 and we decide to buy to open a contract. So we were selling, now we're buying. -1, now we've got one contract. We own this and we are in control. So the option type is a call. We're buying a call, and we're doing this because we are bullish. We've looked at Coca-Cola, we've done our analysis, and we believe that Coca-Cola is going to fly through the roof when earnings pop out. Maybe we looked at Pepsi before that, and we're already feeling really good about this position, but we put our position on after Pepsi came out. So again, that's going to increase the premium that you're going to pay because, again, volatility is going up. So Pepsi came out with good news, right? So more and more people are going to be buying calls, driving the price up. So the reason or the why behind this is, well, it's a volatility play. Again, we're looking for volatility where it's not really expected. And we want a big payoff in this case, okay? You can win small, you have small wins as well when you're buying a call, but we're looking for that big payoff. We're looking for lots and lots of volatility. So we're going to pick a strike price of $55 a share. So that's right at the money, right? It's at $54.98. So we call that at the money. We're buying an at the money call. Now I'm going to link a video up above, and it kind of goes into some more of the nuance when it comes to buying puts and calls. So the way that I like to play it. And that'll go into more detail. This is going to be kind of surface level so we can kind of understand how this transaction works. But go watch that video, and that should help to also maybe some, fill in some questions that might come about from our discussion today. So for now, just understand that we're buying an at-the-money call at $55 strike with the stock at $55. We're directionally bullish. We're betting that when earnings come out, this thing's going to take off and go flying. 57, 58, 59. We're going to make a bunch of money, right? That's the goal here. Now, we're only giving ourselves 3 weeks till expiration, so we're not paying that much for time value. And I would typically buy more time. I would buy a longer expiration. But in this case, our play is all about earnings. We're betting on earnings coming out and being really positive. So the premium that we're going to pay for this is $160, and I'll show you that trade in a minute. But that's our only requirement. Where we needed $5,000 over here, and we had to buy $5,451 in 100 shares worth for this covered call. Here, we just need the cash for premium. This is what attracts a lot of people to the buying side. So I just need $160, and that's my bet. Yes, it's just like going to Vegas, plunking down $160 for a bet where you could win $10 or $1,000. Just depends on how far, how fast this stock moves after earnings come out. So our break even here is going to be $56.60. Again, so we have a $55 strike price and we're paying $160. So move the decimal point over to $1.60 and add that to 55. So 56.60 would be our break even point. This is the point where if we write it out all the way till expiration, we have to get to break even. If it goes up to 57, 58, 59, we're going to be making money even waiting all the way till expiration, which often does not happen. A lot of times people will settle it down here, right? And they're going to sell to close. So you may be thinking, how much money can I make with an option like this? Well, let's remember, one contract gives you control of 100 shares. So for every point it goes past your strike price of 55, you make $100. So let's say it goes to 58. 58 minus 55 is 3 times 100 shares. That gives you a $300 gain. But you did have to pay the premium up front for this option. So 300 minus 160 gives you a $140 gain overall. So that would be your profit in this trade if you waited all the way to the expiration date. Now, just like that put and that covered call that we talked about, you don't have to wait that long. So if Coca-Cola takes off and the value of your option increases, you can always close that out, sell to close, and take your profit at that point. And I did add this down here at the bottom to illustrate a point. So if you did decide to do this on 10/14 at the end of the day and you paid $160 in premium to buy this option, and then you went, I made a mistake, I want to turn around and I want to get rid of this thing, you probably would lose about $10 because the width between your bid and your ask is pretty sizable. And I'll show you that when we flash over and look at the trade in Fidelity. But if you decided that same day on 10/14 to turn around with the stock price unchanged and you decided, okay, I bought to open one contract and I want to get out of this contract now, so I'm going to sell to close out that position, you'd probably only get about $150 for it and you would lose $10. So I just wanted to include that so you understand when we look at this trade how that could impact you. And here is that trade on Fidelity. So in this case, we were buying to open a contract, one quantity, a call, November 4th expiration with a $55 strike. And what I was talking about there is if you look at this bid and ask, there's $22 between that bid and that ask price. So if you were to buy to open and then sell to close, you could lose a little bit of money in that transaction. And that's not the case for all stocks, but this particular one showing right here is a great illustration that can cost you money when there's a big difference between your bid and your ask price. So this is a market day order, and you can see the gain is unlimited, right? Who knows how high Coca-Cola stock could go? Probably not that high. It kind of slugs its way along, but that's the max gain. They show it as unlimited. Whereas the max loss is only the money that you invested in this, so about $170. And again, there's our break even with Coca-Cola. So that's our trade. That's how we would set it up on Fidelity. So that's our example of buying a call. Now, if you have any questions on any of this information, please ask down below and I'll be happy to get back to you. Now, I tend to write or sell lots of puts and calls, and I do that much buying of puts and calls, but it doesn't make it the wrong decision. I know for some people, when they first hear about this, they look at it and they go, well, that sounds like gambling. But the easy way to think about it and say it's not, it's just another side of the same trade here. Sometimes you should be over here and sometimes you should be over here. It's just harder to get it right over here. But this one costs $160 for selling this at the money call with a directional bet on Coca-Cola, knowing that you have to overcome this premium. Well, okay, that's $160. Maybe that doesn't sound good to you, but what if it was only $120? What if it was only $60? Or what if it was only $10? At some point, you hit the tipping point, and this becomes the right decision. So always keep that in mind as you start exploring options like this. Now, again, any questions? Ask down below. So that's part 3, buying a call. And part 4 is going to be all about buying a put. So hopefully we'll start pulling this all together. It'll start making sense. And then we're going to dig into the guts a little bit, start breaking it down into some more components here so we can understand how this all works together. So if you have any questions on any of this, please ask down below. If you like this type of content, please like and subscribe. I really appreciate you watching. Have a great night. Take care. Whoop.